Sit up and pay attention. Do not worry about one Fed governor's mortgage forms, because we're likely looking at a monetary reset already in motion. The Trump administration is moving to take control of the Federal Reserve's regional banks, and that means the price of money itself could soon be dictated directly from the White House. Today, I'll show you how this connects to America's $9 trillion refinancing cliff, and why the Fed is being bent into an arm of fiscal survival, and why gold keeps breaking records. And I'll explain why insiders are whispering about something even bigger, the so-called Mar-a-Lago Accord, a plan to weaken the dollar, inflate away the debt, and reset the global monetary system. If you take nothing else away, take this. Do not assume the dollar is untouchable, and do not assume the Fed is independent. The reset is coming, and the only safe exit is owning assets outside the system: physical gold and silver. The attempt to fire Fed Governor Lisa Cook was never about her paperwork. It was a warning shot, because by moving against a sitting governor, which is something no president has ever tried, Trump signaled to every official in the Fed system that their positions are conditional. Do as you are told, or find yourself in the dock. Regional Fed presidents whose reappointments come due in February got the message. For more than a century, this process was ceremonial, but now it's becoming a battlefield. A Trump-controlled board in Washington could veto reappointments and force through more compliant replacements. Cook's sacking was the skirmish. The regional purge could very much be the war. And the timing is not coincidental. By the end of this year, $9 trillion of US debt must be refinanced. And that is the biggest rollover in American history. And it comes just as foreign central banks are heading for the exits. A decade ago, they held over a third of treasuries, and today, barely a fifth. China has been selling aggressively and buying gold, and China has trimmed its holdings. After Russia's reserves were frozen in 2022, the illusion of the so-called neutral dollar collapsed. Every finance ministry from Riyadh to Brasilia saw the risk. Your reserves are safe until Washington decides they're not. Which leaves the US increasingly forced to fund itself. Banks, pensions, Wall Street, even Social Security are now among the largest buyers of treasuries, but these are not strategic holders. They buy for yield. If the yield vanishes or inflation bites, they'll sell. That fragility is why the White House wants a compliant Fed to cut rates, not to support jobs or mortgages, but to manage the refinancing bill. And this is where Stephen Miran enters the picture. Trump's hope-to-be newly installed Fed official is not a routine bureaucrat. He is the architect of what many people call the Mar-a-Lago Accord, a modern-day Plaza Accord with a Trumpian twist. In Miran's view, the dollar's reserve role is not a privilege, but a burden. It keeps the currency artificially strong. It undermines US manufacturing and forces chronic trade deficits. So what's the remedy here? Well, tariffs, a weaker dollar, and a revaluation of gold. With Miran inside the Fed, monetary policy and political strategy can finally align. Lower rates weaken the dollar. Higher gold prices create confidence in the reset. And America's industrial revival is framed as the prize. Now, since late last year, gold has been surging, flying past $3,300 an ounce. And not because of a token rate cut, but because the market senses something bigger: the deliberate engineering of a weaker dollar and gold positioned as the only safe anchor. Meanwhile, the domestic buyers of treasuries are already straining. Banks are drowning in government bonds worth less than they paid, and pension funds are stuffed with IOUs instead of productive investments. Even Social Security has been pressed into service, diverting capital from citizens' retirement to fund Washington's deficits. The system is cannibalizing itself. It's recycling savings into ever larger piles of government debt. And in a move that would possibly be funny if it weren't so serious, the Treasury has leaned on stablecoin issuers as creditors. Tether, a Caribbean-based company that mints dollar-pegged tokens, that now holds more treasuries than some G7 nations. So should confidence in those tokens crack, it won't just be crypto in trouble, but US financing itself. At that point, who really sets the conditions of US monetary stability? The Federal Reserve or a private token shop? And yet, Markets barely flinch. Yields tick up. The dollar softens. Equities yawn. This indifference is not resilience. It is cynicism. Because investors long ago concluded that the Fed is political. Since the bailouts of 2008, the QE of 2010s, COVID money printing, independence has been somewhat of a pantomime. Now, what matters to markets is only the next cut, the next injection of liquidity, because they no longer police fiscal excess. They assume it. But here's the point. If even an attempted White House coup against the Fed barely stirs the market, the illusion of independence is already dead. And when independence is gone, what is left? Politics. And politics does not care about your savings. Many commentators warn this is reckless. A president sacking governors, then stacking the board and purging regional presidents just as $9 trillion must be refinanced. The risk, they say, is inflation, a bond market refault, an erosion of the dollar's role as a reserve currency. But others argue that this is not recklessness, but design. Cook's firing was the warning. The regional purge is the mechanism, and Moran's blueprint is the strategy. Inflation is not the accident, and it's a stealth default, a way of shifting the cost of debt from Washington onto savers and wage earners. Shadow buyers like Tether aren't policy innovation, but signs of desperation, proof that the system cannot fund itself without extraordinary props. Now, whether you believe the sober economists or the so-called conspiracy theorists, the conclusion is the same. Either Trump is recklessly politicizing the Fed at the worst possible moment, or he is deliberately capturing it to execute a reset. And both paths lead to the same place: a weaker dollar, higher inflation, and stronger gold. And remember, if all else fails, there's always the Fed itself. Printing money to buy treasuries is not free. It is confiscation by stealth. Inflation is not a policy mistake, but the default option. It's a gradual looting of savings dressed up as policy because wages lag, costs will rise, the value of currency drains away. History has shown us how it ends, because creeping inflation becomes chronic, and the chronic becomes crisis, and then collapse. So what we are watching is not Trump throwing a tantrum at the Fed. It's likely the deliberate alignment of monetary policy with political survival. The refinancing cliff makes independence intolerable. The Fed is being turned into an arm of fiscal management, dollar devaluation, and systemic reset. Now, markets may stay asleep a while longer, but investors might be shrugging, but gold is wide awake. Gold does not need the central bank credibility because it doesn't bend to politics. It can't be printed or seized. It is the one asset that tells the truth. So pay attention. Whether this reset succeeds or fails, it will not be painless. But if you want to come out the other side with your wealth intact, you need something outside the decaying system. And that means physical gold and silver, assets that remain yours, always, no matter how the reset plays out. And if you're interested to find out more, click on the link below and come and talk to us.